it's like the perfect storm for writing annuities right now. I can't even tell you how like they're low hanging fruit. There's a lot of low hanging fruit for a lot of reasons. I highly encourage you guys to like watch this recording a few times because the life business is going to pay the bills. And there's nothing wrong with that. The majority of what I've written since the day I got here is life volume. But why would you be stepping over annuity opportunities when they're plentiful once you know what you're looking for? And that's where you really pump up the bank account and maybe you can get another office or staff person or whatever. I mean, that's the chunky money. Okay, so I'm going to go ahead and share my screen. So now let's pretend that I am, that I am back for the second appointment. I believe this is the one. Which one is it? Yeah, I think this is.
Drop a BA in the comments below if you're enjoying some Brad Allan right now. And then drop a PA to show Patty Allen some love too while he's pulling this up. So BA and PA.
Okay, so China, can you tell me if everybody's seeing this? Oh, okay, there it is. Perfect. All right, so before you go to do everything that we're talking about, couple of things. You obviously have to be contracted. In this case, we're talking about Athene. Okay, so we're going to run an illustration in our second appointment with a prospective client, Grady and Patty. And but before you can even do that, you have to have been contracted with Athene, and you need to have your login credentials. And just it's like any other carrier. You can't go into the portal until you've been appointed with them. So let's do that, please. Get your contracting done, and make sure that you're in good standing for at least Athene's Agility, Performance Elite, and Ascent. Just those three products. Okay, so you've got your writing codes, you've got your login. You could write either an Agility if that was the requirement, or a Performance Elite if that's what they were looking for, or an Ascent. Just those three. Okay, writing codes and in good standing on those products. So I'm back for my second appointment, and I'm sitting with Grady and Patty, and this is what I'm showing them on the screen. I'm logging into Athene. And this is going to show my actual numbers to the nation. So that's interesting.
Oh.
I'm not making up the 13.9 mil. That was sitting right there.
We'll blur that out when it goes to the next level.
I had to not show that. All right. So then you pick your state that you're in. Okay. And we're in Arizona. And I'm just going to show the Performance Elite right now. That one is performing really well. So Grady Allen, and you're born 01/01/1957.
Let's go.
And so that makes you, did I do it right? I'll just go down here to age 65. Okay, so there I've got the prospective client's name and their age. And this is money that came in from an inheritance. We're going to say that this was money that you guys inherited from like Grady's father passed away and left you with like $3 million. You still have like 2-point-something left, right? Okay.
Dad so was a great guy.
We got a good, we love Dad.
Beautiful home.
Yes,
love Dad.
Everybody loves Dad. All right. So that would make this non-qualified money. So this is the way I remember it. I don't know if it's right, but this is how I remember it. Qualified money means it's qualified for deferring taxation. That's like a 401k.
Okay.
So you're not going to pay taxes now, but when you're in your 70s, you're going to be paying taxes. Okay. So, but this wasn't that. This was just money that was given to you in an inheritance. So that would make it non-qualified, just like money sitting in the bank account. Okay. So no waiting on, you're going to pay taxes on it someday. So it's non-qualified money. We're in Arizona. Grady Allen, 65 years old. Okay. Then I go, and this is how I'm running all of my illustrations. With this particular product, I just will tell you the Performance Elite is like at an all-time high for how much cash bonus they give the clients for rolling their money over. In Arizona, check your states. In Arizona, a 7-year Performance Elite is a 6% bonus. So you roll over 100K, you would have 106. They would give you 6,000, 6%. 6% on what you roll over. The 10-year, and that's what I'm going to show you, the 10-year is 16. A year ago, it was 8, and now it's at 16.
It's incredible.
It is. I mean, so you roll over 100, now you have 116, and all you did was just like protect the 100K. Pretty nice, right? And I know you guys, when we sat down last time, you owe what, I think 500 on the house? Is that what, is that about approximately 500? So why don't we just show that? I know you have a couple million, but the numbers are yours. You decide what the number is. Let's look at like if you were to pass away, this house would be paid off for sure, no matter what happens in the stock market. How's that sound?
Okay.
Okay, so we'll put in 500,000. Okay, and then the index, just for people that are watching, the indexing strategy is really what drives this investment vehicle. So the index, we have a choice to do S&P, we can do NASDAQ, we can do the AI powered, or we can do the B&P Paribas. I think it's actually Paribas. Somebody told me the other day, it's like, don't pronounce the S. Anyway, I've been saying Paribas forever, so I'll just keep doing that. The B&P Paribas is a diversified index. So you've got one company, one agent, one product, one index. It sounds very risky, right? You always hear about diversification, diversification. Well, when you get to the index, that's where it gets diversified. So your risk is diversified across this index. So I'm going to put you here at 50%. Your money will check in half of it in the first year and half of it in the second year. Okay? And so I put in 50% of your money, so like it'd be 250 would check in the 1 year, and 250 would check in the 2 year. Okay, so I put in my indexing strategy and just make sure that it totals 100 at the bottom. It won't let you move forward and actually show an illustration unless it has 100% distribution across an index. It starts off with putting 100% in the fixed strategy. So make sure that you zero out that 100, okay? Otherwise, you're going to be showing people just a fixed strategy, which there's nothing wrong with, by the way. They're actually pretty high right now. All right, and then for withdrawals, for right now, we're not even showing any withdrawals. You're going to avoid a required minimum distribution because it's post-tax, and we'll get into that at another time. Today, I want to just keep it super simple. We're kind of staying right down the middle of the road. This is a nice couple. They see value. They've set another appointment, and I'm building credibility, right? So first off, Athene. Everybody wants to know, who is Athene? So it's like the Greek goddess Athena, but with an E at the end. So it's Athene. They're traded on the stock market, you know, ATH. That's their ticker, ATH. So if you want to check them out, see how their financial strength is, it's ATH. So it's Athene. They have 241 billion of assets under management and growing. So this time last year, we were processing as a company about 2,500 apps a month. Right now, we're doing 25,000. So we're growing massively. Why? Just like you guys, people are tired of losing the money they put into these accounts, and they're getting worried. So we've been rolling over a lot of money from the market into the index products. And so big company, they actually, you know the Boeing company?
Sure.
I used to work at Boeing. And so Boeing's 401k plans, they're managed by Voya, or at least they were when I was there. The little orange bunnies on TV, Voya, right? So the reinsurer to Voya is Athene. So if Voya runs into trouble, Athene takes over their contracts. The reinsurer to Athene is Goldman Sachs.
Oh,
so this is, you know, East Coast money, deep pockets. So basically what I'm trying to say is that they're highly regulated, you know, and they're completely liquid. For every dollar they take on, they have to have $1 in reserve, unlike the bank, which, you know, is like a fractional reserve. They have to keep a dime of every dollar.
Yeah.
Athene has to keep $1 for every dollar. So they have to be 100% liquid, and they're reinsured by Goldman Sachs. And there's special funds they have to donate to. They're not donating. They're regulated to make sure that it's not FDIC like you see in a bank. But I mean, for me, they're big, successful companies that've been around. They win awards, and they're highly like scrutinized for their business. So it's safe. I put my wife's, wherever she is, I put my wife's retirement in there, my mother's retirement in there. I get one of these every year. I mean, I got money. I'm not looking to waste it. I like guarantees. I guarantee you guarantees are fantastic for clients. So when I'm showing this illustration, what I do is it's a single premium fixed indexed deferred annuity. So it's a long-term retirement savings product that can help protect you from outliving your money. And that happens to be the number one risk or the number one worry in retirees' minds is, did I save enough? Am I going to make it? It's just a lot of stress when you're worried about money in retirement. And that's what we do for people, is we take that stress off the table. So I always show this page. It's basically marketing. And I always build up the company. What I just told you is what I say in every single appointment. Okay. That's what I'm showing you. Okay, and then the next thing, this is kind of how it works. There's guarantees. Back when I used to put people in the market, first thing they told me when I got there, forget the word guarantee. You can never say it because there are no guarantees in the stock market. Could go up, could go down, who knows, no guarantees. That's not us. We have guarantees. It never goes negative. You can pull from it. Obviously, that would reduce the account value. But the market isn't going to impact your downside risk. You don't participate in down. Remember when I sat with you guys last time, the red line, the green line? The green line never went down, the Warren Buffett story, right? This is what they're talking about. So growth potential, yeah, there's no guarantees it's going to grow because it's based on an index of the stock market. Did you know there's 3 countries that went down for 20-year periods? Japan in the 80s. Italy and France in the 2000s. So like the Y2K thing where the 4-digit thing with computers.
Yeah.
France and Italy, they didn't get back to where they were in the year 2000 until 2020. Japan, wow. Could you imagine going into your retirement and having a down market for 20 years? So markets go down, and that's normal. It's when it goes down that impacts you, right? So if you're early in your earning years, it doesn't matter. But if you're approaching retirement, a down market can really sink you. And so protecting that retirement fund becomes even more critical the closer we get to the retirement. So you're sitting with the right guy.
Awesome.
Let me put it that way. The premium bonus, like I said, it's an all-time high, 16% in Arizona, nothing wrong with that. And then in protection, just like I said, there is no downside market risk to your money. So getting it when it goes up, you don't get all of it. You participate in it, but they take the little bit across the top you don't get to protect the downside risk, so you're benefiting from that. The taxation on this is, since yours is post-tax money, that money's never taxed. It's already been taxed. Mm-hmm. But the gains, when you take out money from this account, if we move forward, those gains would be taxed. And it's a LIFO strategy. So the last thing that goes into the account is the first LIFO, last in, first out. The last thing that went in would be the interest you're gaining. That would be the first thing to come out. That would be taxed. But when you get down to the original money you put in on a non-qualified account, that's never taxed, okay? Because you've already been taxed. So you're going to defer that taxation until you pull out those gains. You're getting interest on top of money that would have otherwise been taxed, which is another beautiful thing, right? And then income, you can turn these things on and get a systematic distribution so that you've got a predictable cash flow in retirement. And then if you pass away, this money stays in the family. It's an insurance product, so you'll have to have a beneficiary. Does that make sense?
Yeah.
Okay. And then these are the indexes that we chose. It's a diversified index across stocks and bonds in both the US and Japanese markets. So it's 2 countries, 2 economies, 2 types of investments, stocks, bonds, when one's going up, the other one isn't. So it's well balanced and it has a consistent return, and that's why I'm recommending that for you guys. Okay? And then if you look here on this chart, you'll see on the BNP Paribas, it's the 4th line down. In a 1-year check-in, 87% of the time, it's throwing off some kind of interest. In the 2-year, you'll see on the 5th line down, 100%, no, sorry, the 3rd line down, 100% of the time. So over a 2-year period, you're never going negative. We already talked about that. But over a 2-year period, it's going to throw off some interest historically. Doing a 10-year look back. This is a hypothetical illustration, but it looks back and it pulls real numbers. This is how this thing has performed. It's not guesswork, right?
Awesome.
That's really important. So now you'll see on this page, this shows 0 interest rate. So that's assuming a down market. Remember, 0's the hero. You never go negative. So let's assume it is a down market and you're moving over $500,000 on a 10-year contract. They're giving you a $50,000 premium bonus. Is that right? Let me just check. Yep. So that's a 10% income bonus. That's interesting.
Maybe it's based on age?
No, I don't think so. So I think the rates just changed. I think our bonus just went down. So yesterday that was 80.
Still 10%.
It's 10%. So we'll come back to that. But my point here is that, look, even when a down market occurs, you know what I did is I think I chose the wrong thing. That's okay. 550 never goes backwards because this one doesn't have a fee inside it. So I didn't do the plus. That's all right. Something's off. Anyway, so you always show this 0 interest page because people are like, I don't get it. How can it never go backwards? I get that question all the time. How is it that I was losing money, but now that doesn't make any sense to me?
It's too good to be true.
It's too good to be true, right? So let me explain it this way. So Grady, this mouse, I am in love with this mouse. I'll give you $10,000 for this mouse.
Sold.
Yeah, but not today. So here's $100 to reserve the option to buy this mouse for 10 grand a year from now. So you're like, okay, I'll take $100. So I come back in a year and it's not worth 10,000, it's worth 100,000. Well, I would exercise that option. You said you'd sell it to me for $10,000. I gave you $100. I bought the option to buy it for 10K and it's worth 100K. I would exercise that option. Obviously, I'm going to make, a lot of money. But if I come back and it's worth like $150, it's like, wow, was I off? I was going to give you 10 grand and it's only worth $150. Keep my $100. I'm not going to exercise that option. So the difference in the market is their shares, and these are option contracts managed by a lot of people managing the index. Okay. So indexes are going to go up because they're going to exercise options when they make sense. Whether the market's going up or down, you have the option to exercise that purchase, right?
Okay.
And you've got a bunch of guys and gals, not just I have a great guy. You have a whole team of them managing these indexes for all of the people in the index. So it's so well diversified and it's got history and it's consistent and it's strong. Otherwise, I wouldn't be putting my own money there.
Sure.
Yeah. So that's the 0 interest, not super exciting, but let's look at how it most likely would perform. So they do a 10-year look back. Doesn't mean the next 10 years are going to be the same as the last 10 years, but this is the way it has performed in the past. And you'll notice there's an 8, there's a 30. Now, what does that tell you? If there was a cap, it certainly wouldn't be 30. Caps are usually like 9 or 10. So this is an uncapped strategy. So remember I said you participate on the green line with the red line, but there's no cap to your participation. So the market goes up 35, say, well, you went up 30. You participated in that 35 to the tune of 30, as opposed to a capped strategy where if it went up 35 and you're capped at 10, you can never get more than 10. So uncapped is always better than capped. Wouldn't you agree?
Yes.
My 550.
Yeah.
My 500.
Yeah.
By the end of the second year, in this hypothetical example, is worth 770.
Yeah. If the next 10 years were to perform like the last 10 years.
And then the next year, the market clearly didn't grow.
It corrected, yeah.
It corrected. So I still have my 770.
Yeah.
And then the next year, so this is, I'm 4 years into this thing, and you took my 500 to 859.
Correct. If the next 10 years look like the last 10 years.
How is
Pretty
that?
powerful.
Is that common?
No.
Okay.
No. I mean, so up until last year, 2022, we were on an 11-year run. Normally, the market corrects every 6 to 7 years. And
Okay.
the correction means that it's going to come down like 10% or something like that for like 6 months on
For the
average.
other people, not for us.
Not for this.
Not for this.
No, you don't participate in that 10% down market. You would slide across that. But like the most down markets last between like 6 and 18 months.
Okay.
We haven't experienced a France or Italy or Japan. We haven't had a 20-year down. Doesn't mean we're immune to it. I mean, there's a lot of things happening in our world right now when I was a kid that I would have never imagined could be happening. And so could we have an extended multi-year down period in the U.S. stock market? 100%. Absolutely. That can happen. There's no guarantees the stock market in the U.S. can't stay down for an extended period. So if you're approaching retirement like you guys are, that you've heard of buy low, sell high.
Yeah.
Well, maybe you've lost some account, but it's still at its high point. So that's where you lock in what you don't want to lose.
Okay.
All right. And right now we're not talking about the whole enchilada. We're talking about 500 of the 2 mil, right? Because that would pay off your house. You can roll over more if you want. I'm just illustrating this number for you.
Okay.
All right. So yes, it grows without risk and deferred taxation. This chart right here, you guys, this is probably my favorite chart. And what this does, this shows you the most recent 10 years, the highest 10 of the last 20, and the lowest 10 of the last 20. And what you'll see here, yeah, I did illustrate the wrong product.
Yeah.
I did the Performance Elite 10, not the 10 Plus. That's what it was. That's why it wasn't a 16.
So the 16 still exists.
16 still exists.
16 still exists.
Yeah.
In Arizona.
Yeah, because if this was the
In
Performance...
Arizona.
Yeah. It's going to be between 10, 14, or 16. It's 16's good though. It's the highest. So if it was the Performance Elite 10 Plus, you would see after a 0.95 rider charge, after you're going to get that extra cash bonus, and so there would be a 0.95 annual charge. And even if you had a 10-year down period, you would still be further ahead because you got 16% in a bonus. And even if it went down every year, you don't go down, but that 0.95 comes out. So like 10 years times 0.95, it'll be less than 10%. You got 16.
Has the market ever gone down 10 years in a row?
No.
Okay.
Not here. No.
Not here.
No. But, I try to paint pictures and tell stories and relate to people based on my past experience. Did you know that I used to be a banker?
Feel like
Yeah, I was.
that.
I was a banker. But the IT guy in
IT banking.
Right. But I mean, I was around capital markets and everything. And in 2008, do you remember 2008 when everything
Certainly.
crashed hard? Yeah. So I was at Washington Mutual Bank. I can say that because they don't exist anymore.
Correct.
Right. And so I lost like 750 grand in a day.
Okay.
That's a lot of money.
Ton of money.
Right?
That's a ton of money.
Yeah. So, I mean, I'm kind of like on this mission. I'm trying to help people protect their retirement funds with a vengeance because I know what it feels like personally to have to start over when you're like pretty well into your career. And I don't want that for people. So this is fantastic. You'll notice that the most recent 10 years here is 8.5. The highest is 12.8 and the lowest is 8.54. So the banding is so tight. If you get over 5 to 6% interest with no downside risk, think of it this way.
Okay.
You're at the craft, or you're at the tables at Las Vegas, right? You're playing 21.
Okay.
And every time the dealer wins, you don't give him any money.
Sold. I'm in.
And every time
That's such a good example.
And every time
that was worth showing up today because that was a legit example.
But every time you win, you only get half the pot.
Sold. Still
Right?
in.
It's like deal faster.
Yeah. Deal. I can play twice as much.
Nobody would ever leave that table.
Ever.
Right? Because you never lose. That's what this is. You may not get all the pot, but when you lose, you don't have to pay because you actually never go backwards. That's pretty rock star. Anyway, I really love this chart because it's showing that, it's not like some years you're going to do 20 and some years you're going to do like 2. the banding is really tight. Are we getting any questions that I
Couple.
should be? Okay, I have one more page.
Yeah, no, keep going. We'll do questions. So, and we can just hold on. Don't type them in. But if you've got one, we got a few minutes, and Brad will answer some.
So I have one more chart, and this is really important to show in an illustration, is that you always have access to your money. So there's a couple of dings on annuities. People first, when they hear annuity, they think variable. Oh, my dad told me never go into annuities because you could lose money. We're not talking about variable. We're not talking about fixed. Fixed doesn't matter what's happening. It's always the same. We're talking about an index. It's the hybrid. It never goes negative, and it's going to participate in the gains. In this index, the BNP Paribas, no cap, right? You can take out 10% of your account value annually, no withdrawal charge. 10%. So like we showed 550.
Okay.
You could take out 55,000, no withdrawal charge.
Okay.
But let's say that it's.
But in my example, this is to protect my mortgage.
Correct.
So I don't want to touch it.
But let's say.
But if God need it, we got to do a remodel.
Exactly.
One of the kids moved back home. We got to add an addition on.
Right.
We need 50. Okay.
Muggsy needs a new diamond collar or something.
Muggsy needs a new diamond collar.
Let's say that it's year 5. Okay. And so for easy math, you have $500,000 in there. So you could take out 50 grand. That would be 10% of $500,000 be 50 grand. But you took out 51. For whatever reason, you took out 51, not 50. So you went $1,000 over your 10% account value.
Okay.
In year 5.
Okay.
So Athene, this company, Athene in this case, will hold back $100 because the 1,000 is the only part you went over your 10%.
Okay.
So they would give you a check for $50,900, not $51,000. They would leave $100. So my point is, you're not hit with a 10% withdrawal charge on the whole 51K. Just the amount you went over your 10% of your account value.
Now, what if it's year 5 and I haven't taken any money out? Is 50,000 the most I can take out?
10% of account value annually.
Does it ever go to 20%?
Okay, so with some products, not all products,
okay,
but with
not
some
all products.
And this one, maybe you saw that and I missed it. Thank you for bringing that up.
I knew
it is. So with this one, if you skip a year, you can double down in the next one. So if you don't take your 50K, the market tanks, you still have $500,000. And so now you could take out 100 in year 2 because you defer taking out the 50 in year 1. So, and then it resets. So It's like you can go and roll over your 10% into the next year, but that's a one-time thing. And then, if you start over. So It's not like one time for the whole 10-year contract. It's just if you skip a year, you can double down. Then if you skip a year, you can double down. Kind of like that. So yeah, super strong. It goes up, not down. I just say I'm kind of like Mr. Visine. I get the red out. I'm just trying to get people, as many as I can, just get the red out. I don't want to lose any more money. Move the money you really, truly don't want to leave at risk. Hopefully it's got another intention. In this case, it would pay off your house if something happened to. Does that make sense?
Tremendous sense.
Okay. So we're at about an hour. Do you want to take some questions?
We'll do 5 minutes of rapid fire questions.
Okay.
But let's do some clarifying. So clients protected, they're playing blackjack, they never lose, and they take half the pot though. The red is gone. Money doesn't go down, it can only go up. You got some limitations on what you can take out each year, but ideally for your client, you're putting money away that they don't need readily accessible. It's more for retirement or protection or some savings money that maybe they need to discipline themselves and lock it away so that they don't touch it and keep buying stuff with it.
Right.
Okay. $500,000, hypothetical.
Yep.
Hypothetical, new agent. What would be a commission for a new agent on that amount?
About 26K.
$26,000.
Yeah.
Okay.
And these are plentiful.
China's jaw just hit the floor.
So these are plentiful. It's all about the questions. If you're sitting with 5 or 6 people a day and you just get in the habit of always asking these questions about identifying where the money is, you will come across many, many, many $500,000 opportunities over the phone.
So the cynic will go, well, that comes from the client. Well, you go, no, it doesn't, because we're giving them a bonus too.
Yeah.
And regardless of where it comes from, the insurance company's paying you, not the client.
100%.
And we see the 500 goes to 550 on this product. So you're doing your job as an insurance broker, and you're doing the client a service as an insurance broker, and everybody wins. So,
yeah. People ask me all the time, how do you get paid? And it's like, I'm not the one that puts you in the market with a good plan that may or may not work, and I get a fee based on the assets I manage, whether they go up or down. That's the older evil version of Brad. Now
Yes.
the newer, nicer version of Brad that can say guarantee. I take people out of the market to protect their life savings, and they never go negative, and I get a 5.1 time thing, and it doesn't come out of your money, because in this case Athene, they don't give me a desk or benefits. I'm 1099 to them, but I represent only A-rated companies that are big, old, rich, and really good at what they do.
It's good.
Yeah, annuity companies bailed out banks. When I was going under at WAMU in '08, annuity companies were actually bailing out banks. They're the masters at managing risk, better than the casinos. They know how and when we're going to die by gender and age, like to the day.
Actuarial scientists. It's an
Yeah,
art. Yeah.
they're good.
Okay, we're gonna do some questions.
Okay.
You know, if some of these are completely out of left field and you prefer not to answer,
Oh,
then
I'm good.
by all means.
Yeah, I'm
But
good.
we'll do a few minutes of questions. If you have them, drop them in here. If they're written, then we'll go for it. Isn't the inheritance taxes when cashed out? I'm not sure if that makes sense.
Is
to
the
me.
inheritance taxes when? So I'm not a CPA. What I would say, if somebody's inheriting something and then you're sitting with them, all taxation issues have already been accounted for. This is money that they can roll over without any penalty. It's like 99% of the time I write an application, there's not going to be a penalty for rolling that money over. There's no cost and there's no risk.
Okay. What would you say is the biggest downside slash con to annuities?
So the biggest downside, and this is what you'll need to overcome, a couple of things. The idea of annuity, people think that it's too good to be true. You can lose money. My dad, my parents, whatever, told me stay away from it. Just talk about the three types. Indexed is the hybrid between variable and fixed. You don't do variable because you don't have a license to let people lose money. Your license only protects money. It only goes up, not down. Fixed is fine. There's nothing wrong with fixed, but if the market comes soaring back, you're going to miss that bounce back. So that's where the index comes in. So the index is the oh, I'm waiting for the Fed to pivot the interest rates. Well, you're going to get the pivot. You're just not going to participate anymore down. The other thing is that how my money's locked up. So I'm saying, like, what I hear people repeat, they parrot it back to me from like a financial advisor. Not that there's anything wrong with that. That's fine. I mean, if you're speculating and you're risk reward, that stuff, that's not our people. So you're like the other side of the aisle, they'll say, well, your money's locked up. Well, two things. Having 10% access to your account value annually without a withdrawal charge, two things. You're not going to outlive your nest egg in 10 years. It's putting the governor on your spend, and you're not going to see a fee. Okay? So the worst thing that could happen is, while I need this money to live on, it's dropping, with nothing that I had to do with it. I just put it with the person I trust. It's dropping as I'm pulling from it and paying a fee. I'm paying somebody a fee to help me lose money. I'm going to run out of money. That's a sequence of returns. Sequence of returns is what you should fear going into retirement. This takes that risk off the table. So yes, 10% access of your account value annually, but that avoids you from outspending your money and getting a fee. So you do the liquidity planning up front. Liquidity is what you want. That's the key objective that people may not know. That's what you would consider it as. But like on the life side of our business, it's all like, what object? I don't need it. I already have it. I can't afford it. I'm not ready. Let me think about it, right? There's objections on the life side of our business. There's objections on the annuity side of the business too. And one of the objection is, my money's locked up. Okay, so you address that liquidity stuff up front in the planning. You guys have a couple million. We're moving a half million. So you still have 1.5 million to play around with. There's no liquidity issue going on here.
Yeah.
Right? So that's what you want to do. Is like, so with this 100K you have just sitting in the bank account, do you have any big purchases coming up? What do you have earmarked for that money? Nothing? This is just in case money? Well, then let's move half. Because then no one can complain about liquidity when you're only moving half. It's when you take too much and you lock down so much of their liquidity, that's where that argument on the other side of the aisle actually has some merit. But if you do your planning up front and you're moving like half to three quarters, liquidity is not an issue.
You have it with a broker, go up and down in the market. You have it with an annuity company, it goes up with the market. So you're trading liquidity for guarantees.
Correct.
Which, when we're dealing with clients that have money and don't want to lose it,
Correct.
guarantees sounds far better if I've planned appropriately to not need to buy something significant in the future.
Absolutely. Yep.
So,
Yeah.
okay, there you go. Good question, Braden. Lawrence is, how much does Athene pay out in percentage? I think we covered that.
5%. Yeah. When
And-
you're starting out,
And
5%.
it goes up from there.
Yeah.
For 500K, we covered that. Steven says, wow, this is a permanent payout, almost zero out cancellation rate.
Okay. So chargebacks.
Oh.
I think that's what you're saying there, right? So once people get over the mental exercise of getting out of the game, the risk-based speculative investment with some portion of their, portfolio, once they've funded the annuity, jumping back into speculation is really pretty much unheard of. I mean, it's less than like a 1% chargeback ratio. Once you're done, you're actually done, and they're your client for life.
It's awesome.
Yeah.
All right, last two. Is there a minimum age to buy annuities?
Yeah, it depends on some products. So check the brochures. Like each carrier's product will have a brochure. It will vary with age, and so does the commission. So what we're talking about typically with annuities are people that are older. So so there's an age restriction on how old you can be. So like Athene 84. So you can go up to age 84. And I think with the fixed, you can do 85, but with the indexed, I believe it's 84. Again, don't quote me on this. Check your product. This is a homework assignment. You should be reading these brochures anyway. But they're typically people I sit with are usually in their mid to late 60s or early 70s, almost all of them.
Hypothetical would be at 84, they're going to attach a death benefit to it that's going to be bigger than the cash value, and then they're putting themselves on a risk for a higher expense based on 84-year-old actuarial tables, because the 84-year-old it's shorter time left on the wick. So
I sat with a lady a couple months ago, Hillary, and she was 83, and she couldn't get into a 10-year because she was too old. But we put her in a 7-year, and so she was fine with that.
It's good.
Yeah.
Okay. Are there any annuities we can do for New York residents? I don't know if you know.
I don't believe we can.
I would reach out to
Jay Rosencrantz.
Jay Rosencrantz.
Yeah.
Do you ever use indexes with a charge?
So New York residents, if they have another residence, use that one.
Okay.
Yeah. No, what was that second question?
Do you ever use indexes with a charge?
I don't. And maybe I will. I did years ago because the participation rate was pretty low. And so that was one way to pump it up, was to add a charge to it so they get a higher percentage of participation in the index. But the participation rates right now are so high, there's no reason, in my opinion, to add any more charge to this. It's like the perfect storm for writing annuities right now. I can't even tell you how like they're low-hanging fruit. There's a lot of low-hanging fruit for a lot of reasons. I highly encourage you guys to watch this recording a few times, because the life business is going to pay the bills. And there's nothing wrong with that. The majority of what I've written since the day I got here is life volume. But why would you be stepping over annuity opportunities when they're plentiful once you know what you're looking for? And that's where you really pump up the bank account, and maybe you can get another office or staff person or whatever. I mean, that's the chunky money. But that doesn't mean that you abandon what got you to the chunky money. Do not do wholesale. Oh, I'm just going to be an annuity producer now. You'll go broke. Don't do that. Just stay the course.
Got to find them.
You got to find them, right? And this is how you find them.
It's awesome. We'll wrap it there, Brad, and Miss, my better 9/10, Miss Patty. Thank you so much.
Absolutely.
Everyone, this is the beginning of your new now found passion for looking into the complete usage that you can take under your wings of utilizing your insurance license, and the complexities of variable and the markets and all those things are put at ease as an insurance broker, because we get to leverage IULs and now FIAs, of course, both, and that puts a lot of power in your license. So beyond grateful to Patty and Brad and the time they've given us. This is the first of a few part series we're going to have with him as we're progressing this new SRS education. So I hope you're all enjoying it. But all that matters is the time you put in and the confidence you get to start asking the tougher questions. And they're not tougher questions, they're funner questions. What do you have that acts like life insurance that would help with the expenses if, God forbid, something happened to you yesterday, right? You never want to kill them in the future or that the day of. You kill them yesterday. And just start asking those questions, finding some money and utilizing the Ask a Specialist, utilizing your mentors, reaching out and starting to progress towards evolving yourself as a full spectrum producer. So Brad, Patty, thank you so much for your time. Please light up the chat with some ones and some emojis and some BAs and some PAs and just say thank you to them because they don't have to do this. They're here to help you get better. They're making plenty, but they also enjoy helping. And that's really cool. What FFL does is bringing great people together to help other people get great. So without further ado, thank you again, buddy.
Right on.
Appreciate you.
Yep.
Thank you all. And we'll see you next week. Bye for now.